The UK economy just sent a warning signal, and most traders completely missed it. While retail traders were busy buying GBP pairs blindly, smart money was already preparing for impact. Because behind the headlines, Britain may be walking straight into a financial storm. Today, we're breaking down the shocking UK PMI data, why the British pound could become extremely volatile, and how war, politics, inflation, and fear are colliding at the worst possible time. What happens next could create massive opportunities for Forex traders. So here's the problem. The UK services sector, the heartbeat of the British economy, suddenly collapsed. Analysts expected the services PMI to come in at 51.7. Instead, it crashed to 47.9. Anything below 50 means contraction. And according to reports, UK business activity just fell at its fastest pace since the COVID pandemic. Not even traders expected the drop to be this bad. But here's where it gets dangerous. At the exact same time the economy is slowing down, inflation is starting to rise again. Businesses are reporting weaker consumer spending, delayed investments, supply shortages, rising costs, and even job cuts. Why? Two reasons. First, the growing conflict in the Middle East. Second, political uncertainty inside the UK itself. People are becoming hesitant. Companies stop hiring. Consumers stop spending. Investors become fearful. And fear is what moves the Forex market. Now let's talk about the pound, because this is where things get interesting. Normally, when an economy weakens, central banks cut interest rates to stimulate growth. But inflation is still high, which means the Bank of England is trapped. If they raise interest rates, they risk pushing the economy into recession. But if they don't, inflation could rise even higher. This is the exact type of uncertainty that creates explosive Forex volatility. And volatility is where traders either make fortunes or destroy their accounts. Right now, institutional traders are watching three things very carefully. Number one, will UK inflation continue rising? Number two, will the Middle East conflict disrupt supply chains further? And number three, can the Bank of England survive the pressure without crashing economic growth? Because if conditions worsen, GBP pairs could become extremely unstable. Most beginner traders think Forex is just charts and indicators. It's not. Forex is human emotion translated into price movement. Fear, uncertainty, greed, panic. When businesses lose confidence, currencies react. When governments appear weak, currencies react. And when war enters the equation, markets become unpredictable. But here's the part nobody is talking about. Manufacturing numbers actually look strong, but analysts say businesses were simply rushing orders early, trying to avoid future price hikes and supply disruptions. In other words, the strength may be temporary. And once that demand disappears, the slowdown could become much worse. This is why smart Forex traders never trade headlines emotionally. They study macroeconomics, central bank behavior, political tension, and market psychology. Because behind every candle on the chart, there's a global story unfolding. So the question is this just a temporary slowdown for the UK, or the beginning of something much bigger? If you enjoyed deep breakdowns on Forex, financial psychology, and global market movements, follow for more.